So as mentioned, my name is John Christmas. Thank you for having us. It's great to be back here sponsoring this event again. At HPS, we have a big commitment in Texas. We have got offices in Houston and Austin and Dallas, and we have a lot of family who are obviously in the state. And so what you all do is very important to us. About 20% of our money is money like yours. It comes from public pensions. And so we think we understand the job you guys do every day, and we really appreciate it. I'm gonna cut to the punchline, and then I'm gonna come back and go through a couple slides. So the punchline is this. Private credit has always existed in the market. And what happens is that the banks blow up every 15 years, and private money steps in when the banks stop lending and says, I'll lend to you at 9%. And then the banks fix themselves up, and then they come back and the banks start lending at 4%, and private credit goes away. And so historically, after every big dislocation, private credit was an interesting asset class. And then like 3 years later, it wasn't. But something's changed in the market, and we're gonna talk about that today. And this is why you should care. If you own liquid loans in your portfolio, you all do. If you own high yield in your portfolio, you all do. You need to look at private credit because private credit has grown dramatically, and it is no longer this little asset class that is around and is opportunistic. It is core to people's portfolios, right? This is something, and the reason is because the Fed doesn't want the banks to hold $300 million in risk to a single company, right? The bank doesn't want the Fed doesn't want Bank America or Bank of the Ozarks or like some of these even smaller banks to have $400 million exposed to a single corporate, right? That's what caused the last crisis. And then if you look at public markets, what happened in the last crisis is if you own a $300 million loan and there's four guys and everyone owns four people, right? And four firms and everyone owns $75 million of it. And something goes wrong and you try to sell it, there's only three people who know that thing, right? And so what happened really in '08 was a liquidity crisis, right? People went to sell and there were no buyers, right? And the reason is some of these things are very thinly traded. And so what people want now is big liquid issuances. They want to own 75 million of a $10 billion bond, not of a $200 million bond. So the public markets don't lend to these people either. So when you have banks not lending, and you got public markets not lending, enter private credit. And it is here to stay. And what you can see of the market today is if you look at the private credit market today in blue, you'll see it's $1.2 trillion, right? The liquid loan market's $1.4 trillion. We're gonna be bigger than it in 2 years. And same thing with the high yield market. Okay, so it's a growing market, and it's a big market, but why do I care? Why am I gonna put this hard-earned, hard-saved money into this asset class? And the reason is because you get a higher return and you get better credit protections, better credit documents. And so we'll talk a little bit about that today. But everyone knows private equity. Everyone thinks private equity makes all this money and it makes more than public equities. And generally they're right? But the private credit is another interesting place where people really should be focusing. And what we're seeing is more and more institutions are focusing. And this is all, and credit is all we do, right? HPS is an $80 billion firm. All we do is lend money to people at a rate of interest that we think is commensurate with the risk, and then we look to get paid back. For this, we get 2 or 3% more than public markets annually on your money, and that's why it's interesting, especially in a very low rate environment. But so at our firm today, 90% institutions. We've got $56 billion in private credit, 24 in public credit. We are the largest firm of our kind. We are the largest independent firm that just lends money and wants it back. Our competitors are Goldman Sachs and Blackstone and these people who have private equity and they have infrastructure and they have credit. But for us, this is all we do. But private credit is not like this monolithic thing, right? There's a whole bunch of different types of companies out there. Right? You may borrow money unsecured on a credit card. You may borrow money against your home. You may borrow money for a business or for a car, right? And it's the same thing in private credit. So what you can see is there's this core senior lending, that this is a name we use, whatever, and that's sort of the beta of private credit. Like, so you can lend money to a company, it's a little bit smaller, you're gonna make 2% more than the public markets, but that's a lot when the public markets are at 4, right? Then we have, so it's called specialty direct lending. Now this is when the company's a little bit more esoteric. Maybe there is some sort of IP asset that they're trying to borrow money against, right? And on these loans, you can get 9%. Right? These aren't companies that are going out of business. These are growth companies that are trying to acquire their competitors, right? Then you have, power and renewables. You can lend in the U.S. to renewable projects. You're going to get 6%, right? If you're willing to do transitional gas projects on the lending side, get 9%. Right? Relative to, but if you're going to invest in renewables equity, you're probably going to get 10%. So on the relative risk reward, people really like the lending to these, even though it's a low return, when you compare it to equities, it's a relatively good return. Then there's special situations. Everyone knows this, the distress company, the cyclical business that's at the bottom of the turn, revenues are down, but it's going to come back out, but just needs a little bit more money to survive, right? Those sort of private credit, you can get high teens, taking a lot more risk, right? But and then obviously there's strategic partners, sub-debt, asset value. You can lend against items, right? So if you walk in to buy a forklift and you fill out a credit application in the US, we may be the ones lending you the money, right? If you're trying to buy kitchen equipment for a new restaurant and you want to finance it, right? That's asset-backed lending against forklifts and kitchens, and maybe it's a conference system for a new law firm, right? But wildly diversified loans, very small loans, another interesting place. And then there's obviously real estate and so on and so forth. So yes, private credit is interesting, but it's not just one thing. There's lots of different flavors, right? And this combined is the thing that's reaching this $1.5 trillion industry, we think, in a couple years. What drives private credit? Well, people buying stuff and need a new credit, right? You can always refinance people, but that's a different game. The real thing is when people need credit is when they buy something. So who's buying? What are people buying? Well, private equity are buying companies, right? And a private equity firm's buying a company. If that company's worth $1 billion, right? Let's say it does $100 million in EBITDA, and someone's saying 10 times EBITDA, so they're paying $1 billion for the company, and they want to borrow some money. They can go borrow $400 million of that billion in the private credit market today. It's probably the only place they can borrow it. Again, too big for the banks, too small for public markets. And so what you've seen is M&A, private equity, the M&A activity is obviously at an all-time high, mostly driven by private equity. And so you'll see financial sponsors, that's a term people use for private equity. So another term that people use, Wall Street loves using terms to make things seem difficult to understand. It's very simple. Sponsor, private equity firm. Non-sponsor, everybody else. Family-owned businesses, management-owned businesses, public companies, right? But sponsor-backed lending tends to be what most private credit is. At our firm, it's about half of what we do, but that's the main thing. And so the people say, well, if I give money to the private equity firm and they're buying the business, well, why wouldn't I just lend to them? Like if I'm comfortable owning it, I should be comfortable lending them money, right? And private equity is never going to do anything wrong to hurt me because they're smart guys, right? Well, but that's actually not true. Private equity is very good at driving returns for their investors, but this is an interesting dynamic which we've seen, which is private equity M&A is driving it. By the way, if you look at the amount of money private equity has now, this isn't stopping, right? Private equity firms, you give them money, they have 4 years to spend it. They're gonna spend it. Right, and so if you look at the private equity money sitting on the side, that's actually what's giving some people pause here in the market today. And another thing that's giving people pause in the market today is how much money people are paying for businesses. Right, it used to be a business was worth 10 times earnings. Today you see software businesses go at 18 times, 20 times. Like that's a lot for a business, right? If you're thinking about how much money, how long is that going to pay back? How many years? If I'm paying 20 times what they earned this year, how many years until I get all that money back? I mean, it's not 20 with growth, but it's a lot. It's pretty far out. And so you have seen purchase prices increase, but what you actually haven't seen is them taking out more debt. what you see is the blue bar on the left on the bottom and you can see it on the right as well, the amount of equity they're putting in is more. Why? Because there's some discipline on the credit side. Because we don't lend to 10 times, right? Like we don't lend just because you think it's worth 20 times or just because you think something's worth something doesn't mean it's actually worth that, right? And so what you've seen is actually, while there may be froth in the public markets, on the credit side, you're actually seeing private equity firms put in more money, and we're actually not seeing that. And then this is the punchline. And so with all this in there, in your portfolios, if I can if the industry can get you a couple hundred basis points more, right, and they can do it with better documents, right, and that's the other part of private credit. In the public markets, there's something called covenants. So when people borrow money, there's covenants, all these rules that you have to follow. Like you can't, like when you buy your house, right, you can't take in more debt. You can't have somebody else come in and lend you more money in front of the bank, right? Like if anyone comes in and lend you money, they come in behind the bank, right? Like, and they start chipping into your equity. In public markets, that's not the case. These forms are very light. They call them covenants. They're just like fire alarms in your house, right? Like if there's a fire around your house, you want your fire alarms to go off. Why? Is it going to save the house? No, it's just so you can get out, right? Maybe call somebody to help. Right? And that's what covenants are in public markets. They're just fire alarms, right? They don't actually do anything other than warn you that there's a problem and you need to do something. And in public markets, they don't exist. In private markets, they do. And so we think not only do you get a higher return, you also get a better yield. But that doesn't mean there aren't some times that are better than others. Still, even in private credit to invest. And what we would say is that time is coming closer, which means volatility. You're going to hear a lot of people talk about volatility. And what causes volatility? It's just now someone said volatility is caused by uncertainty. That's 100% correct, right? And what do you guys think your cup of coffee is going to cost in 3 years? I don't know. I saw on TV today, eggs are up 50%. Like, it's just those little uncertainties in life that cause market volatility. It's not like people worried about what the Fed's going to do in 6 years. It's just like, what's going on? What's going to happen in 3 months? What's going to happen in 6 months? What's going to happen in unemployment? What am I going to have to pay my child care? Like, what's my nursery school going to charge next year, right? And so, like, that sort of volatility leads to public markets volatility. And when public markets get volatile, people who have capital can lend it out and make more money. It's like what Mr. Morgan did at JP Morgan. Lend out your money and get a premium return, right? It's the way wealth has been created for a long time. And that certainty of capital, the fact that my firm's sitting on $25 billion in cash, ready to lend across senior, junior, renewables, real estate, infrastructure, asset-backed lending, pick one of those bubbles. That certainty of capital, that speed of execution is why people pay a little bit more. And that makes sense to people. If I had to go out and beg for my money for 3 weeks, not beg, but go on a road show and go around, or I can go to one person, that person's probably going to charge me more, right? And that's what it is, right? They have a high degree of confidence. Also, you don't have to worry about public ratings. We can actually give you money, and then when you want to buy your competitor, we can give you a little bit more. And so, there's a lot of reasons why, but I think in our firm's case, scale. If you want to borrow $1 billion, there's like 3 people who can do it, and we're one of them, right? And so there's 450 new private credit firms. There are all these small firms. There's a lot of them. You're going to hear from a ton of them. And it does offer a good return. However, where we sit at the market, we sort of sit on the higher side, and that's actually what you're seeing happen in the market today. This is a little bit in the weeds. It's one of my last charts, though, so that's the good news. What you can see is that like the size of these deals, as people get more confident in this industry, more big companies are borrowing private. And so just one thing is if you look at like the number of deals, the top line, it's like a C&I chart. What it says is in 2019, there were no deals where someone borrowed $2 billion in the private markets. And then in 2020, we got our first deal. There was one deal where someone borrowed $2 billion. And last year, there were 7 times when someone borrowed $2 billion. Now, why does that matter? Because on average, I'd rather lend to a big company than a small company. If you told me 2 companies, same, one makes $10 a year, one makes $1,000 a year, I'd rather go to that 1,000 guy, right? He's got more customers, he's got more suppliers, he probably has more businesses, right? And so, in the theory is as the market grows, more larger companies are gonna take this money, and that's better risk. They're not startups. These are companies that have been around for 30 years. And so, this is one of the trends you're seeing in the market. So it also speaks to why we think the market will grow, right? Bigger deals make the market grow faster. So we think it's an interesting opportunity. We don't think the regulatory is going to change. We don't think the Fed wants JP Morgan holding $500 million with a single company. We know it, right? And so these regulatory changes are here to stay, and they appear to be working. And so, we think, that it's an interesting opportunity also globally, although Europe's a little behind. But we're excited about what's to come. Last thing I want to talk to, and then I'll be out of here, is sponsor, non-sponsor. I mentioned it briefly. So do you want to lend to a private equity firm, or do you want to lend to a family-owned business? Private equity firm, really good at borrowing money. They do it all the time. Family-owned business maybe does it every 5 years. Private equity firm, very disciplined financially, really good management probably. Family-owned business, maybe, maybe not. But in order to save Grandpappy's business, they may put in good money after bad. And that's what you sort of see. You can do sort of documents where they have to put in more money if things aren't performing well and other things. And so you'll hear some of this sponsor, non-sponsor. It's a little in the weeds. But we think it's a robust opportunity. We think it's something that you all should be considering for your pensions. And we think it's going to only grow. And with that, I'm done. Thank you very much.